The opening of Asian markets is often treated as routine, a handover between sessions, a regional transition before Europe and the United States take over. But in periods of elevated uncertainty, that first window of global liquidity does more than set prices. It reveals posture. When Asia opens, it is the first test of how markets are digesting information accumulated while others were closed. Positioning that looks stable on paper is exposed to real flow. Assumptions meet reaction. And small signals often dismissed during calmer periods begin to matter. This is why the Asian market open could set the tone. Not because it determines outcomes, but because it establishes context. It tells us whether risk is being absorbed, deferred, or quietly reduced. Asian markets are structurally different from those that follow. Liquidity is thinner. Price discovery is more sensitive. Moves that would be smoothed out later in the day can appear sharper here. That sensitivity makes the open informative, not decisive. It shows how willing participants are to engage before the safety of deeper liquidity arrives. In recent environments, this willingness has become conditional. Volatility is no longer an anomaly, it is managed. Leverage remains present, but less forgiving. Participants are more selective about when they deploy capital, and the Asian session is often where that selectivity becomes visible. This matters because global markets are increasingly synchronized. What happens early does not stay local. Futures, currencies, and rates react almost immediately. The Asian Open is not isolated. It feeds into Europe, then the US, shaping expectations before the largest pools of liquidity come online. The tone set here is not about direction alone. It is about confidence. Are markets comfortable carrying risk forward, or are they hesitant? Are moves met with participation or with caution? These questions are answered not by headlines, but by behavior. Importantly, this is not about predicting a rally or a sell-off. It is about reading posture. Markets can move higher on weak confidence or lower on strong conviction. The difference lies in how participants respond to the first test of the day. If you follow markets for these early structural signals rather than end-of-day narratives, this is where attention becomes valuable. Consider subscribing if this kind of analysis focused on how markets reveal their state through behavior rather than commentary aligns with how you prefer to track risk. The key point is simple. The Asian market open does not decide everything, but it often tells us more than later sessions are willing to admit. It is the first moment where assumptions face flow. To understand why this particular open carries more weight than usual, we need to examine what global markets are currently carrying, and why that makes early reactions more informative than they appear. What makes the Asian market open especially informative is not geography, but timing. It is the first point at which accumulated information is forced into action. Economic data, policy signals, geopolitical developments, and positioning adjustments all converge at a moment when liquidity is thinner and participation is more selective. This creates a kind of stress test. Not an extreme one, but an honest one. During the Asian session, markets cannot rely on the depth and redundancy that later sessions provide. Price discovery happens with fewer participants, which means reactions are less diluted. Moves that might be absorbed quietly in Europe or the United States tend to express themselves more clearly here. That clarity is what makes the session useful. In stable environments, this difference is marginal. In transitional environments, it becomes meaningful. Global markets today are carrying more latent tension than headlines suggest. Positioning remains crowded in places. Correlations are tighter. Volatility is managed rather than absent. In such conditions, the early session reveals whether markets are comfortable maintaining exposure or whether they prefer to wait. This distinction matters because waiting is a form of decision. When participants delay engagement, liquidity thins further, price sensitivity increases, small flows produce larger effects. The market may still appear orderly, but the underlying message changes. Another reason the Asian Open matters is its influence on derivatives and currencies. Futures markets begin adjusting expectations for the day ahead. Currency pairs linked to risk sentiment respond quickly. These moves are not final, but they establish reference points that later sessions must either confirm or correct. Confirmation reinforces confidence. Correction introduces friction. When early signals are aligned with later participation, the market tends to carry momentum smoothly. When they are not, volatility often increases as sessions hand off to one another. This is not coincidence. It reflects disagreement about risk tolerance across time zones. Importantly, none of this implies that the Asian session leads the market in a directional sense. Its role is diagnostic. It shows whether the market is leaning forward or sitting back, whether it is prepared to absorb information or prefers to defer judgment. This diagnostic value is easy to overlook because it does not announce itself loudly. There is no single data point to watch. The signal lies in behavior, the speed of reaction, the willingness to trade, the persistence of early moves. Markets that are confident tend to validate early signals. Markets that are cautious tend to fade them. Observing which behavior dominates provides insight into the broader state of risk. To understand why this particular open is being watched more closely than usual, we need to look at what global markets are currently balancing and why that balance is becoming harder to maintain as sessions roll forward. The reason this Asian market open carries more weight than usual is not because of a single catalyst, but because of what markets are already holding. Global positioning is layered, interdependent, and increasingly sensitive to timing. In such environments, the first meaningful window of liquidity becomes a point of validation or hesitation. Markets today are balancing several competing forces at once. Policy uncertainty has not resolved cleanly. Growth expectations remain uneven across regions. Financial conditions are tight enough to matter, but not tight enough to force widespread deleveraging. This creates a narrow operating range where confidence must be actively maintained. When conditions are like this, early session behavior becomes informative. It reveals whether participants are prepared to carry risk forward or whether they prefer to reassess. The Asian Open is where that preference is often expressed first. This expression is rarely dramatic. It appears in the absence of follow-through. Moves that stall quickly, volatility that rises without commitment, price action that lacks conviction. These are not signs of panic. They are signs of caution. Caution matters because it changes how later sessions behave. European markets do not react in isolation. They inherit context. If Asia opens with hesitation, Europe begins with uncertainty. If Asia opens with clarity, Europe builds on it. The same is true for the U.S. session. This sequencing effect is often underestimated. Markets are global, but participation is staggered. Each session inherits not just prices, but posture. Early signals frame expectations. Another reason this open matters is the role of currencies and rates. Risk-sensitive currencies respond quickly during the Asian session. Yield curves begin adjusting before major cash markets open. These moves influence hedging decisions that persist throughout the day. If early signals are inconsistent, hedging becomes more conservative. That conservatism reduces liquidity. Reduced liquidity amplifies price sensitivity. The process feeds back on itself without requiring a headline trigger. This is where trigger and credibility intersect. The trigger is timing. The credibility is structure. The Asian Open matters because it interacts with a market that has less tolerance for ambiguity than it did in previous cycles. Importantly, this does not imply that markets are fragile. It implies they are finely balanced. Fine balance increases the informational value of early reactions. Understanding this helps avoid common misinterpretations. A quiet Asian Open does not mean nothing is happening. It may mean participants are choosing restraint. A volatile open does not necessarily mean panic. It may mean positioning is being adjusted quickly. The signal lies not in direction, but in engagement. To see how this engagement or lack of it shapes the rest of the trading day, we need to examine how later sessions respond to early posture, and why mismatches between sessions tend to increase volatility rather than resolve it. When early session posture and later session expectations diverge, markets rarely adjust smoothly. They oscillate. This is where volatility tends to increase, not because new information arrives, but because existing information is interpreted differently as liquidity deepens. If the Asian session opens cautiously and later sessions attempt to reassert confidence, the handoff becomes unstable. Prices are pushed forward without full confirmation. Liquidity appears but selectively. Moves are met with resistance rather than participation. This back and forth is not disorder. It is negotiation. European and U.S. markets often assume they can correct or override early signals. Sometimes they can. But when underlying conditions are finally balanced, that correction becomes costly. Each attempt to reprice without alignment increases friction. Spreads widen slightly, volatility picks up, correlations tighten. This is why mismatches between sessions matter. They expose disagreement about risk tolerance across regions and time zones. Asia's caution followed by Western assertiveness does not cancel out. It compounds uncertainty. Derivatives markets feel this first. Futures pricing adjusts quickly, but conviction lags. Options markets reprice risk asymmetrically. Skew shifts before spot does. These are not reactions to news, they are reactions to posture. As the day progresses, the market begins to test itself. Can it sustain moves initiated later in the cycle without the early session's participation? If it can, confidence rebuilds. If it cannot, volatility persists. This process is often misunderstood because it lacks a clear catalyst. Observers look for a headline to explain the movement. In reality, the cause lies in sequencing. The order in which sessions engage matters more than the content of the news. The Asian Open sets an initial condition. Later sessions either validate it or attempt to overwrite it. When validation occurs, markets settle. When overwriting occurs without confirmation, markets remain unsettled. This is why traders and risk managers watch these transitions closely. They are not looking for direction. They are looking for agreement. Agreement reduces uncertainty. Disagreement keeps it alive. In the current environment, agreement has become harder to achieve. Markets are operating with less slack. Liquidity is more conditional. Participants are more sensitive to timing. These factors amplify the importance of early signals. Understanding this dynamic helps explain why days that begin quietly can end with elevated volatility, and why days that begin decisively often remain orderly. The difference lies not in information but in alignment. To understand what this means for positioning and risk going forward, we need to look at how markets adapt once they recognize that early signals are not being resolved cleanly, and how that adaptation influences behavior over time. The final implication of the Asian market open setting the tone is not about forecasting direction. It is about understanding how modern markets manage uncertainty when alignment becomes harder to achieve. In environments like this, markets do not fail suddenly. They adapt quietly, often in ways that are only visible after the fact. Once participants recognize that early session signals are no longer being consistently resolved by later liquidity, behavior changes, not dramatically but structurally. Risk is still taken, but it is rationed. Exposure is still held, but it is managed more actively. Optionality becomes more valuable than conviction. This is how tone translates into consequence. Markets that struggle to establish alignment early in the cycle tend to operate defensively throughout the day. Liquidity providers widen spreads slightly. Traders demand clearer confirmation before committing size. Risk managers become more sensitive to intraday volatility rather than end-of-day outcomes. None of these adjustments appear alarming in isolation. Together, they alter the market's capacity to absorb shocks. This is why the market often underestimates the importance of these early signals. They do not announce themselves as stress. They express themselves as friction. When friction increases, markets become less forgiving. Moves overshoot and retrace more frequently. Trends become harder to sustain. Correlations behave unpredictably. Participants spend more time managing risk than expressing views. This is not instability, it is caution. Over time, this caution feeds back into pricing. Volatility becomes episodic rather than persistent. Liquidity clusters around specific windows instead of remaining continuous. The market functions, but it does so with less elasticity. That reduced elasticity is the real signal. The Asian market open plays a critical role here because it is where elasticity is tested first. It reveals whether markets are willing to engage without full confirmation. When that willingness declines, it does not immediately produce negative outcomes. It produces conditional ones. Conditional liquidity, conditional confidence, conditional participation. This is the environment in which mispricing often accumulates. Not because markets are irrational, but because they are constrained. Participants prioritize survival over optimization. They avoid being wrong rather than seeking to be right. That mindset reshapes behavior across sessions. Importantly, this does not imply that markets are fragile or on the brink of failure. It implies they are operating closer to their limits. Systems under such conditions can remain stable for extended periods, but stability becomes more effortful. It requires alignment that is harder to achieve and easier to lose. This is why the question is not whether tonight's Asian Open will move markets. The question is whether it confirms or challenges the posture markets are already carrying. Confirmation reduces friction. Challenge increases it. And friction matters because it accumulates silently. It does not demand attention until it intersects with an external catalyst. By then, the groundwork has already been laid. From a structural perspective, this is how tone-setting events should be interpreted. Not as triggers for action, but as diagnostics of capacity. How much disagreement can the market absorb before it begins to reprice risk more aggressively? How much uncertainty can it tolerate before behavior changes more visibly? These are not questions answered by price alone. They are answered by participation. If the Asian Open sees engagement, follow-through, and consistency, it suggests that markets remain comfortable carrying risk forward. If it sees hesitation, fading, and uneven response, it suggests that confidence is being rationed. Neither outcome is inherently bullish or bearish, but both are informative. For those who follow markets structurally, this is where attention belongs. Not on dramatic claims about what decides everything, but on how systems behave when they are required to reveal their posture early. As global markets become more interconnected and more dependent on timing, the importance of these early signals will continue to grow. Not because Asia leads the world, but because it tests it first. If this framework has helped clarify why the Asian market open matters and how to interpret it without resorting to hype, consider sharing this perspective with others who approach markets through structure rather than noise. And if you've noticed similar patterns across sessions or asset classes, add your view in the comments. These observations often reveal more than any single data point. The Asian Open does not decide outcomes, but it often tells you how prepared the market is to face them.